On today's hot sheet, I'm discussing the FOMC's January meeting minutes, homeowner tenure, a renter report from Realtor.com, and weekly unemployment data. Today is Thursday, February 22nd, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into today's hot sheet, your 24-hour look back on all things housing. Let me know in the live chat which market you're tuning in from. And of course, to get the most out of everything we do here at BAM Media, make sure that you're in BAM X. BAM X right now, you can get in for 20% off the annual subscription by using code POTUS through the end of the week, POTUS, in honor of our presidents. Use code POTUS and get 20% off of BAM X. All right, let's jump into the news of the morning. The minutes have been released from the latest FOMC meeting. Let's go over them. We've broken it out in the hot sheet show notes, which are available for BAMX members each and every single day that we have a show. And we broke out every time they do mention housing, of course, in the minutes. Okay, so FOMC, Board of Governors and Federal Reserve System, last met between January 30th and the 31st. And then we now have those minutes that were released here in the last 24 hours on that meeting. It kind of gives us a little bit more insight, a deeper insight from Jerome Powell's press conference, which we always do cover. The big headline, and the headline that was on CNBC, okay, is that the Fed officials expressed caution about lowering rates too quickly last meeting. Okay, so this is one of those things that Jerome Powell kind of insinuated in the last press conference. It caught a little bit of the market off guard because there was an expectation coming into the end of the year. We could see cuts as early as the end of Q1 or certainly in Q2. And now we're seeing a lot of Fed officials say, well, we just don't know about that. But we just don't know when these cuts might come. We're unsure. And that date seems to be getting pushed out. And when you have hot inflation reports like we did last week, that date could continue to get pushed out. Federal Reserve officials in their recent meeting expressed this caution about lowering the rates too quickly and indicated that they're in no hurry to do so. The meeting summary emphasized the importance of carefully assessing incoming data to judge whether inflation is moving down substantially to the Fed's 2% target. Now, we know if you take out owner's equivalent rent and shelter, we're actually below the 2%, but they refuse to update the way that they're tracking CPI for sure. On page 7, the last paragraph, we have a quote here. Many participants indicated that they have expected core non-housing service inflation to gradually decline further as the labor market continued to move into a better balance and wage growth moderated further. Various participants noted that housing services inflation was likely to fall further as the deceleration in rents, which we've been calling here, on new leases continued to pass through to measures of such inflation. We've been talking about this. If you go back to yesterday's hot sheet, if you missed it, go listen to the replay. By the way, the hot sheet's always uploaded to Apple and on Spotify each and every single day. If you'd like to do replays there, I'd love for you to jump over there and leave us a review. But go back and listen to yesterday's replay. We talk about all of the units of supply coming in the apartment, multifamily apartment world, and it's dramatically more than last year. It's something that won't only decelerate prices in a lot of these major metros, but it'll actually bring rent prices down. And so the anticipation is when these new leases catch up to the data, and even the new leases we've seen last year, because we saw significant rent deceleration. And many report even drops in rent last year. And some of that hasn't even caught up to this lagging data of how we track shelter in this country. So, but the Fed does expect that to happen. And so they're kind of playing chicken here. If that data catches up in a big way and catches them off guard, they haven't started cutting yet, inflation could be dropped. They might have to be forced to do a bigger cut than as opposed to if they just start doing incremental cuts now. Okay, that's one of the theories out there. The economic outlook from the staff's forecast for January, slightly stronger than December's, with upward revision to the 2023 GDP growth affecting the projection period. Expected monetary policy is expected to keep output growth in 24 to 25 below potential, aligning in 26. Total and core PCE price inflation is projected to step down in 24, reaching close to 2% by 2026. There are inflation assessment, okay? Concerns about elevated inflation's impact on households through data. Recent data indicated progress through the longer run goal. Expectations for core non-housing services and housing services inflation to decline gradually. So they don't expect that to be a fast decline. They expect a gradual, what I've called some bumps in the road. You're driving through that quiet neighborhood, and there's some yellow speed bumps ahead. It's why I've cautioned everybody against promising, guaranteeing, setting expectations too high for a 5 handle on the 30-year fixed. We're now basically 2 months finished here. We're at the end of February, and we're sitting up over 7 on the 30-year fix. If you polled agents the end of December, because we did this game and we actually did our own over under on Knowledge Brokers podcast. I mean, the expectation the end of December was like, wow, low 6s for 30-year fixed for the spring market. I mean, and we're nowhere even close to that, obviously, right now. So gradually, slowly, speed bumps. These are the things that the Fed is expecting. These are certainly the signals that the market and the investors of the market have led us to believe to be true. Longer-term inflation expectations are well anchored, with near-term expectations showing recent declines. Recent. Household sector and business activity. Consumer spending is still stronger than expected, supported by low unemployment and income growth, but expected to moderate. Concerns raised about pressures on low and moderate income household finances impacting consumption outlook. Mixed reports on business activity across industries and districts with tight labor conditions, but some easing in wage pressures. Labor market employment outlook, that is remaining strong. Uncertainty surrounding labor market outlook due to recent trends and potential limitations in labor supply increases. So maybe a little bit of a yellow flag moving forward. On that aspect, risk assessment and financial stability, upside risk to inflation noted, including stronger than expected demand and potential easing of financial conditions, downside risk to inflation and economic activity, including geopolitical risk and negative spillovers from foreign economies. Yeah. Monetary policy actions committee decided to maintain the federal fund rate target range. Obviously, we know that. That's old news. And those are your updates on the Fed meetings. Really, we pulled that from page 7, last paragraph, and you have the quote in there in the show notes available on BAMX. You had that one piece there on housing. Not much to pull from this meeting minutes on housing. The headline is going to read that they're still uncertain about when they're going to cut. I mean, this is what consumers are seeing. They're not picking through that big PDF or our show notes, of course. The PDF is enormous that we pulled from the show notes. But this is what they're going to see. Consumers express caution, lowering rates too quickly at last meeting. And so that's going to be a signal to the market that we're still expecting. Yeah, the PDF's 11 pages, by the way. We'll link that up inside of BAMX if you want to go through. But the show notes, I'll just give you the highlights there, so it makes it a lot easier. But this is going to impact how investors are looking at the market, with the biggest impact coming here this morning, where we hit a high in the last one day here, 4.354 on the 10-year. So we're back up over 4.3. We want to stay away from that 4.350, 4.3875, I think is the real danger zone. We get up over that like we did last year. You got some uncertainty about shooting up over to 5% on the 10-year, which would, of course, signal more 8% 30-year fixed rates. We want to stay away from that. We've been hanging out in this range here for, it seems like, a couple weeks now on the 10-year. And it's what's keeping these rates inflated. Okay, moving over now to homeowner tenure. This Redfin report is interesting, to say the least. And let's pick through the data here from this Redfin report. It's available on nowbam.com, so you can get the full report on nowbam.com. Reminder on the President's Day sale, 20% off using code POTUS for BAMX. Eric looks like a complete. He would be maybe the worst president of all time. I think I'd rank somewhere in the top 5. I'm not going to take Abe down, but in comparison to Eric, it'd be no question. Homeowner tenure, by the way, has doubled since 2005, but currently falls short of the 2020 peak. So 2020 peaked at 13.4 years, but you see from 2005, you just had a consistent step up in homeowner tenure. How long are people going to stay in their home? 2020 obviously was the peak of that. In 2020, you ask somebody, "Hey, you going to move?" I'm not even going outside. I'm not going out to the grocery store without a garbage bag on my face. I'm not even moving. Okay, so there's no chance people in 2020 were thinking about moving, and now that has come back down to maybe a more normal level. But we're still talking about 12 years. Zillow has put out this theory in the past from the executive level. They've talked about this on earnings calls in the past. So it's not just it's something they've thought a lot about. You start talking about an earnings call, you've thought some about it. That they think the homeowner tenure could dramatically shorten as millennials move through the housing market, which I don't agree with because now they're having kids and it's like it's kind of a pain to move with kids. And as Gen Z moves up into the home buying market, their theory was as Zillow, make it easier to have the all-in-one app, basically the everything housing app, the super app, as they call it, for all things housing related, that it would speed up transactions and that it would make it easier for people to buy and sell more often, hence reducing this homeowner tenure and accelerating the amount of deals that can happen in the marketplace. See, Zillow believes that actually technology. I wish I would have asked Logan. We'll have to ask Logan when he comes back on Knowledge Brokers podcast. I wish I would have asked him about this question. Can technology create more transactions, more flow, increase the flow of transactions in a market, or is the market and people are going to move depending on their needs? Okay, but Zillow has put out indicators that they believe technology can help it, speed up the process, which will make it more enticing for people to buy and sell quickly, which would reduce homeowner tenure and increase transactions. I don't know. I don't think technology can replace the fact that the move is actually very different. The physical move, the changing of all the bills, and if you have to do a same day move, Bobby, our great producer here at BAM, he's closing on a house next week. So wish him congratulations in the comments. First time homeowner, and Bobby's like got the benefit of right now being able to stay where he is and move over a couple of month period. We know that a lot of buyers don't have that great fortune of being able to do that. They're leaving a lease and they're going into the new house, and it's all happening at once. You feel like the world is crashing down on you. This is why, agents have to, as Dave Ramsey always says, have the heart of a teacher when you're dealing with clients, or a lot of times people say, hey, nurses are great at real estate. These are some of the theories that have been out there in the past, and it's because they are. But by the way, the Jimmy Carter of presidents, whoever made that comment, I hope that was for Eric. That was for Eric, okay? Because if I'm the Jimmy Carter of presidents, the Denton realtor, I am doing something dramatically. But clip that out and send it to Eric. Eric, you are the Jimmy Carter. I think Jimmy Carter is 99 though, so we shouldn't be. I'll take the lifetime tenure of Jimmy Carter. I think he's not. I think he just turned 99 years old. There was a photo floating around the internet of him recently. Yeah, so way to go, Jimmy Carter, on that. I'll take that tenure any day of the week. But okay, so anyways, going back to, it's a very stressful time, and agents, we know this best, right? All the agents in the chat, you guys know that what we're doing, helping buyers, sellers on these moves, it's very emotional for them. It's a very stressful period of time. And because of how hard that is, and there really hasn't been, unless you're doing something to solve the problems locally, deep in your community, there really hasn't been something that comes along, certainly not technology, that makes the move easier. That makes that whole process easier, unless you're a white glove, high service agent connecting the dots, the vendors, and all those different things in your local community. And so to me, it's no surprise that since by my clicker's not working right now, that since 2006, when people were getting rid of a lot of homes at a high rate, that this homeowner tenure has just gone up each and every single year. People are staying in place longer, and we're sitting at 12 years right now. Maybe your community is a little bit less. If it is, be thankful for that. I know here in the Northeast where I'm sitting right now, it's all of 12, if not more. People stay in their homes forever. That reduces turnover rate. It becomes harder for like a farming campaign. If the turnover rate is like 12 years in a farm, that you're looking at, that's going to be it's going to be hard to really capitalize there. But just side note, if you're looking for farm on mail, you want 6% of the homes or more turning over. That's kind of rule of thumb if you're farming. If you got 3% of homes turning over in a particular neighborhood or area, it's going to be a little bit harder or very difficult to get a return on that. But okay, so homeowner tenure has doubled. We get the point there. Kind of went on a rant. My apologies on that. It's nearly double the 6.5 years from 2005. And the report stems from analysis of median U.S. homeowner tenure by year as of 23, based on historical county records. The report defines homeowner tenure for 2023 as the number of years between the most recent sale date of a home and December 1st, 2023. So most recent sale rate. Homeowner tenure is increasing as baby boomers are aging in place, as opposed to going and finding that smaller home. In fact, almost 40% of boomers have lived in their homes for 20 years or more. So maybe this number does decline as we get into 10 or 15 years down the road. Another 16% have lived in their home for 10 to 19 years. As for Gen X, more than 1/3, 35%, have lived in the same home for a decade or more. Millennials, on the other hand, typically live in the same home for shorter periods, partly because they're younger, so they're probably like in that move-up phase, their starter home, and now they're going to move up. They're more likely to switch jobs compared to the older generation. So less than 7% of millennials have lived in the same home for 10 plus years. I mean, listen, I'm an OG in the millennial demo. I'm on the last year of being a millennial or whatever it is on the border there. And I've never lived in a home for 10 plus years. The house we just bought, and my wife's like, we are staying here until the kids are out of school, because every 2 years, basically, we've moved. I think the longest is like a 3 or 4 year. You find an opportunity, especially if you know the market, if you're, educated on your market, like we could sell and make 200, we can sell and make 250, and you kind of keep rolling that over. But boy, I tell you, it wears on you when you're moving every 3 years. That is something that eventually you're like, I want to have a place for the next 10, 15, 20 years. I'm there with her. Although I could make some money on this house, even though we just closed on it, I'm enticed to do so. But it's annoying. It's annoying changing addresses and moving and doing it all that work. And so, um, but no surprise, as millennials are growing that nest egg or building that career, building that future, there's no surprise that less than 7% of millennials have lived in the same home for 10 plus years, 13%, 5 to 9 years, 30% for less than 5 years. Almost all Gen Z have lived in the same home for most of Gen Z are still living in their parents' house. So this doesn't even make sense to me. But I guess Gen Z homeowners, okay, all of Gen Z homeowners have lived in the same home for less than 5 years, which makes sense. Of course it does. Gen Z, the oldest Gen Zer turned 26 in 2023. And we know Gen Z just getting into home ownership. The American population is aging, by the way. A little fun fact here. This article is filled with a whole bunch of good stuff. Go to nowbam.com to get the full report here. The American population is aging. About 17% of Americans were 65 plus as of 2020, up from 13% in 2010. Okay. Jimmy Carter pulling up the average quite a bit. Boomers and Gen Xers are more likely to own homes. Almost 80% of boomers and 72% of Gen Xers own their home, compared to 55% of millennials and 26% of Gen Zers. Almost 80% and 72% boomers and Gen Xers own their home. Reasons for homeowner tenure has increased since the early 2000s, okay? Older Americans staying in their home longer. We covered that one. Among baby boomers who live in their home, more than half, 54% of them, own it free and clear. So their costs are extremely fixed, right? Insurance and property taxes running just over 600. So even if it's a bigger home than they need and they got the thing free and clear, what the heck? Moving is difficult. So why move? Almost all boomers with a mortgage have significantly lower rate compared to what they would have if they bought a new home with today's rates. Plus, some tax systems have policies that incentivize aging in place. Texas homeowners age 65 and up can defer property taxes until they sell their home. Wow. So Texas may want to look at that. I mean, they got inventory, so maybe not a problem for them. But if you're a high inventory situation or a low inventory situation, rather, that would be something that's holding inventory back. Nice to do for the seniors. Californians have Proposition 13, which limits property tax increases for homeowners. Okay. It's obviously contributing to the housing shortage, and we'll see where it goes. Here's the highlights for homeowner tenure. Metros with the longest homeowner tenure are LA. Typical homeowners live in their home for 18.7 years. San Jose, 17.8. Cleveland, 17.4. San Francisco, 16.7. And Memphis, Tennessee, 16.5. Wasn't expecting that list, but that is the list. California homeowners tend to have longer tenures because of that Proposition 13 incentivizing them to stay longer in their homes. And California has historically had inventory shortage issues in a lot of those areas. So interesting that they have that as a rule. So there you go. That's the Redfin report on homeowner tenure. You can find that on nowbam.com. Let's take a quick look at a rental report just released here from realtor.com. Realtor.com's 2024 rental report continued a trend of year-over-year rent declines for 0 to 2 bedroom properties across the U.S., with median asking rents dropping slightly. So Realtor.com has been on the side to say, hey, rents are dropping. Okay. CC Jerome Powell on that one. Zillow keeps kind of going oppo direction on that, saying rents have gone up a little bit. Obviously, a deceleration down from where they were. January 2024 marks the sixth consecutive year-over-year rent decline for 0 to 2 bedroom properties, according to Realtor.com. Median asking rents dipped by $5, so really nothing, or 0.3% year-over-year, with median rent in the 50 largest metros decreasing to $1,712. Okay. U.S. median rent declined by 0.3% year-over-year for 0 to 2 bedrooms across the top 50 metros, with that median rent being, again, just over $1,700. Here's the chart. All the charts, as always, will be available for you inside of BAMX, so you can download those. Rents decline again, but nationwide rent is just 2.6% below the 2022 peak. Median rent up over $1,700. That's the red line. And then you see year-over-year median rent on a straight decline, and below any level there that we've seen in the last 5 years. So good news there for the fight against inflation. Studios saw the biggest rent. Let me get back there. Okay, here we go. Studios saw the largest rent declines in comparison to 1 bedroom and 2 bedroom. Here's the national rents by unit. Overall, $1,712, 0.3% decline year over year. The studios were down a full percent at $1,400. 1 bedrooms at almost $1,600 went up 0.1%, and 2 bedrooms went down 0.6%, almost $1,900. In the last 4 years, 2 bedrooms are up 20+%, 1 bedroom are up 18%, studios up 12%, overall up 18% in the last 4 years. That 18% was basically all in 1 year, right? In 2022, 21 to 22, you really saw most of that, like 16% up on rents. Okay. And when you look at a 10-year window, just like you do on housing prices, rents are always going to go up. Point is, right now, they are decelerating down. And we just need the Fed to take notice of that. Dawn, Texas older homeowners can move that tax benefit with them to new homesteads, so that the bullet point there might be misleading from Redfin. Okay, so Dawn says that they can move that. And Dawn, maybe that is something that I guess Texas agents would want to get out in front of some of those older homeowners. Maybe they're under the belief that they can't move it. Now, I would imagine not everybody knows that. And getting that information out in front of those aged homeowners that are maybe aging in place in a little bit too big of a home, that they can move that tax benefit into a smaller home and cash out at a high price, depending on where they are. Um, Cash out at a high price and move that into a lower home, with obviously increased inventory right now in many parts of Texas. So more options for them there. Here are the 50 largest metro areas for rent year over year. You've got Atlanta down 3.8%, Austin down 3.6%, Boston's up 2.7%, Chicago's up 4.2%. Cleveland and Columbus are both down in 2% range. Dallas is down 1%. Dallas is going to be much bigger than 1% drop in rent prices this year. We saw all the units on yesterday's hot sheet that are coming to the market in Dallas. Expect a much bigger drop there. Houston's up 2.8. Indy's up 3.5. Jacksonville's down 2.2. Bunch of units coming on in Jacksonville. I'd expect that number to keep going down. Miami down 3.4%. You had starts up in Miami, so that number is going to come down. Memphis is down 5.5%, 4% in Phoenix. So a lot of these major markets, a lot of these major rental markets are down year over year on rent prices, according to Realtor.com. This is great news for the fight against inflation. Okay. Let's take a quick look here at weekly unemployment data. Initial claims for unemployment decreased by 12,000 to 201,000 in the week ending February 17th. This job market continues to be very strong. Unemployment data being very strong. You got to get into, I think Logan mentioned on the Knowledge Brokers podcast, you got to get up over 350,000. We're at 200,000 to really have any type of, concern about the unemployment numbers. The 4-week moving average decreased by 3,500 to 215,000. The insured employment rate was 1.2%, with 1.862 million insured unemployed, a decrease of 27,000 from the previous week. Actual initial claims under state programs totaled just under 200,000, a decrease of 11.6% from the previous week. Jersey had the highest insured unemployment rate of 2.9%, followed by Rhode Island, California, and Minnesota. Kentucky, California, and Nevada experienced the largest increases in initial claim, while Missouri, Pennsylvania, and Texas saw the largest decreases. So there you go. The punchline there on labor market is really unchanged. I mean, look at the chart there, kind of flat and overall down a little bit when you compare it to summer. So unemployment data is very strong. That's one of those things that is more of a yellow flag to the Fed that keeps their fight against inflation a little bit harder than they would like it to be. 4.305 on the 10-year right now. Yesterday's 30-year fix came in at 7.14. Been hanging around that range here for a little bit. The Freddie Mac 30-year fix weekly will come out today. I only expect that number to go up from 6.77 of last week. Okay. There is your hot sheet for today and for the week, of course. Hot Sheet is now a Monday through Thursday show when the markets are open. This is your only live show on the internet with a 24-hour look back on all things housing. Unless there is breaking news tomorrow, I will see you back on Monday. But don't forget, over on the @Knowledge Brokers podcast channel, separate YouTube channel, we do release a new show every single Friday with myself, Tom Toole, and Lisa Chinati. If you missed that Logan episode from last week, definitely go check that out. We'll have a new episode there for you guys tomorrow. Hope everybody has a great Friday and a great weekend. This is signing off for the week here on the Hot Sheet. Until tomorrow for KBP and Monday on the Hot Sheet, 9:30 on the East, 6:30 on the West. You know the deal in between. Of course, toodaloo.